Chapter 22, Budgeting. Okay, so far we've looked at the objectives of budgeting and talked a little bit about how it impacts human behavior. And then we talked about the basic elements of the budget process and who's involved in it. We talked about two major types of budgeting. And now we're going to look at the master budget for a company, and then the steps in preparing a basic operating budget. And this is the big piece that you want to know right here, okay, how to prepare an operating budget. And even if in your life, if you aren't part of the preparing part, you'll be subject to a budget, or if you have a project that you want to promote, you're going to have to put a budget together for it. So these are good concepts that you can use in a lot of different ways. So a master budget, okay, master budget, integrated set of operating and financial budgets for a period of time. Okay, so the operating budget helps you prepare the income statement. It tells you what your company is going to be doing that year. The financial budgets deal with cash management, and they help you prepare the budgeted balance sheet. Okay, so most companies do this like on an annual basis. It's too big a job to do any more than that. You do forecasts in between. So here's a sort of a, this is an order of how these budgets are done. Okay, we start out just like when we prepare income financial statements. We start out with the income statement, and the last one that we do is the balance sheet. It's the same thing in preparing budgets, okay? And we begin with sale. Believe it or not, you've got to know this order, okay? So have it make sense to you so that it's just normal and you can see it. But for operating budgets, we start out with, well, what are you going to sell? Okay, we're not going to know the cost of goods sold until we know what we're going to sell. All right, and in order to know cost of goods sold, you've got to know what are we going to produce, how much materials do we have to buy, what is the labor going to cost, what's the factory overhead, okay, what will that be in here? That would give us all the cost of goods sold, and then selling and administrative expense is pretty straightforward. Okay, but once we get this done, the operating budget, then we've got to do financial budgets, and that's cash. Like even if you've got great sales and good growth, the cash budget can show you that you still need to borrow money. All right, so that and a capital expenditures budget, because you know how, we don't pay cash or receive cash at the same rate that it's reflected like in an income statement. Okay, like just because we sold something to somebody doesn't mean that the cash comes in. The cash may not come in until 2 months later. So we actually use those assumptions and forecast cash receipts to see if we've got to borrow any money. Okay. So here's a nice summary of the operating budget, and it starts out with the sales budget. If this is what they're going to sell, if this is what marketing and sales tells us they're going to sell, then you go to the operations department and say, well, how would you produce? And to get the production department ready, you've got to figure out direct materials, direct labor, and overhead. Okay, then we've got cost of goods sold. Selling and administrative expenses are like easy compared to the rest of it. They're just on the side. And after we've got this, we've got a whole income statement. So see how it goes in income statement order. So sales, this is cost of goods sold. Okay, that's what's underneath cost of goods sold. Selling and administrative expense, then that's your budgeted income statement. So the sales budget is your favorite one. It starts out by estimating the quantity of the sales. You might revise them because you've got a pricing changes or economic conditions have changed. For example, there's a pandemic that might change your sales quantities. And once you've got that, you multiply it times the expected unit selling price and you've got a sales budget. Okay? So here's an example. We've got wallets and handbags. Two different regions, East region and West region. This is our expected volume, and there's our unit selling price. So this would be the projected sales. All right, so I don't know, they made this an awful big deal. You could have just added up. Oh no. Oh, they did. You could have just added up, taken the total wallets, 528,000 times 12. Okay, and for handbags, 280,000 times 25. Okay, and that would have given us total revenue from sales. But they divided this up into regions and then by product and made a big production of it. Now, production budget is a different story, and this is going to have a different series of formulas in it than you've seen before. But the thing of it is, one thing to understand is that we produce so much for a month and we say, okay, that's what we need. But then at the end of the month, you want to have something to start the next month out with, because maybe it takes 2 weeks to get production back out at the next month. So you have to have a percentage of your inventory that you also produce for the following month. So what we have here is our budgeted production will be how many we're going to sell and then how many we need at the end of the month. Okay? So the way you want to think about it is unit sales or expected sales plus desired ending inventory. Okay, we've got to have some for January 1st next month or we won't have anything to sell. Okay, so units to be sold plus desired ending inventory. And then what we do is we subtract what was on hand at the beginning. Okay, less beginning inventory. That gives us units to produce. Okay, so sales plus desired ending inventory less beginning inventory gives us what we've got to produce that month. Okay, it's a little bit different. And here are our wallets and handbags. They have, we've given us some data here. We've got an expected ending inventory for both. Or no, the estimated inventory on January 1st. So this is our beginning inventory. And our desired ending inventory is here. Now, usually desired ending inventory is a percentage of the next month's sales. Like it might be 10% of the next month's sales. And here's the production budget for them. So here's our expected units to be sold. We added the desired ending inventory that was 60 and 80 from here. Okay, desired ending inventory. Take a subtotal. All right, these are units required less beginning inventory from January 1st. These are units to produce. And this is one of the schedules, one of the budgets that you need to be able to prepare, so you need to understand this. And here's an example of this land and awards. I'm going to get rid of this. Well, I can't. No place to hide it. I could cut it. Here we go. Land and awards projected sales of 45,000 brass plaques. They project 45,000 plaques. The beginning inventory is 3,000 units and the desired ending inventory is 5,000 units. What's the budgeted production for 2015? Okay, let's put in, let's do our own here. All right, what are we're going to start out with sales, right? Our sales are, where are our sales? Oh, sales are 45,000. And then we're going to add desired ending inventory. We want to have 5,000 units on hand at the end of the month. I'm going to take a subtotal. Or this is the amount needed. Okay, you can think about it that way, maybe 50,000. And then less beginning inventory. And our beginning inventory is 3,000 units. Oh, oops. Darn it, you know. It's always something. And this would be production. Production would be 47,000. Okay, so we started out with sales, added desired ending inventory. So we need to have 50,000 units that month. We've got, on the beginning of the month, we've got 3,000 on hand already. So we only have to produce 47,000. Okay. And there's our answer, 47,000. Okay. Now direct materials, and this comes off the production budget. If we're going to produce 47,000 units, then how much do we need in materials to produce that? So that's what the direct material purchasing budget gives us. So the first step, we're going to figure out direct materials required is we figure out what is our budgeted volume times the direct material, expected material quantity per unit. Okay, so materials required for production plus desired ending inventory minus the beginning inventory again gives us the amount of direct material quantity to be purchased. So the budgeted direct materials then are, let's look at a schedule. This, I don't care for this, but direct material quantity to be purchased times the unit price. So let's look at what we've got. This Elite Accessories, for a wallet, they need 0.3 square yards per unit, and for leather, and then for a handbag for leather, they need 1.25 square yards. Okay, so it's a pretty good hunk of leather. And then they've also got lining. Lining is 0.10 for a wallet and 0.5 for a handbag. And this is our unit price information. So leather is, we've got 18,000, I'm sorry, the price is at the end. We've got 18,000 square yards of beginning inventory for leather, and we need 20,000 at the end of the month. For lining, we've got 15,000 estimated beginning inventory, and we need 12,000 at the end of the month. Okay, so then we just have to figure out what our sales are. So we'll take our sales plus desired ending minus beginning, and that would give us how many yards we need to purchase, and then we can multiply it times our prices, and we've got a pretty good estimate of what we need for direct materials. And here's our price. For leather, it's $4.50 per square yard, and lining is $1.20. Okay, so here's the here's a spreadsheet on it. Let's see this. I thought I did this, but apparently not. All right, so here are the square yards needed for production. For the wallet, note A. 520 units times 0.3 square yards is 1556. We'll do some problems on this too, okay? So you'll have a much better idea once we do problems. And then for lining, it's 520,000 units times 0.10 yards, so that is 52,000 yards. And here's the same process for handbags, and there's our desired ending inventory. Okay, so these are the square yards required, less beginning inventory, the result would be the yards to be purchased, times the price per square yard. There's the direct materials to be purchased. There's the cost. Okay, I actually don't care for the way they did this. I'd rather have it up here. So we start out with so many units, then 0.3 yards per unit gives you this. Okay, I think it's better to keep it all right in the column. So here's an example. They budgeted production for 47,000 brass plaques. They're required to produce, brass sheet is required to produce a brass plaque. Assume that 96 square inches of brass sheet is required for each plaque. The estimated, so there's our beginning inventory, and there's the desired ending inventory. If it costs $12 per square inch, what's the direct materials to be purchased? Okay, let's take a look at this. So we have the square inches retired for production. We're going to produce 47,000. Okay, that's the budgeted production, and we need 96 square inches per plaque, so we need 4,512,000 square inches. We want 200,000 left over at the end, so that means we require 4,712,000 less the beginning inventory gives us 4472. Okay, times our price per square inch. Hope you can see that. 12 cents gives us our direct materials required to be purchased. We'll do each one of these though. We'll do different problems on it. Next one is labor, and labor is real straightforward. This estimates the direct labor hours and then the cost. So hours and cost needed to support the required production. So it started with sales, and then we did production, then we did materials, now labor, and after this overhead. So the labor cost department, first we figure out the labor hours required, and then determine the cost by hitting it times the hourly rate. Okay, whatever the labor hours are times the hourly rate. So here's the wallet again. Oh brother, they've got cutting and sewing department. We've got two different departments here that both have hours. They're making this awfully hard. It could have just been one department. The estimated direct labor hours are, the rate rather, is $12 in cutting and $15 in sewing. So here's our schedule. And again, they've got numbers and notes. So first of all, these are the hours. We've got 520,000 units at 0.10 hour per unit, 52,000 hours in the cutting department, 130,000 hours in the sewing department. Okay, and then for the handbag, no, B, yeah, we've got 292,000 units times 0.15 hours per unit gives us 43.8. And for sewing, it's 292,000 times 0.4 hours per unit, 116.8. Okay, so there's our total hours required now, 95.8 and 246.8. Times the hourly rate gives us our total direct labor cost budget, almost $5 million. And these poor people aren't making any money. You know what I mean? An hourly rate of $12 an hour. Okay, so now we're back to the plaques. Budgeted production of 47,000, and each plaque requires engraving. We'll do this ourselves. Assume that 12 minutes are required to engrave each plaque, and if engraving labor costs $11 per hour, what's the labor cost? Okay, too bad you're not here. I could ask you questions. So we've got production of 47,000, right? Just have it make sense. 47,000 plaque. And each plaque, minutes per plaque. Did I spell it right? Yeah. Minutes per plaque are 12 minutes per plaque. So how many minutes do we need then? 47,000 times 12. We need 500, okay, total minutes required. 564,000 minutes. So now I'm going to take that and I'm going to divide it by 60 minutes per hour. 564 divided by 60 gives me 9,400 hours. Because people aren't paid by the minute, are they? 94 hours times my direct labor rate. I should write that in here, huh? My direct labor rate is $11 per hour. And use dollar signs when you need to, okay? Because see all the numbers that we have here? We've got these are units, these are minutes. Okay, here I've got hours, so label things when you can. 9,400 times 11. Okay, 103,000. This is our direct labor budget. Oops. 103,400. Okay, do you think we're right? Here's our cheat sheet here. Yep. 103,400, that's their number. All right, but have it make sense to you when you do it so that it's all normal. that it's, yeah, that's what I'm going to produce, and it's so many minutes per plaque, 12 minutes per plaque, so that gives me 564,000 minutes. Then I've got to divide it by 60 because I've got an hourly rate. Okay, so that gives me 9,400 times $11 per hour direct labor, gives me a direct labor budget. Okay, now factory overhead estimates the cost of each item of overhead needed to support production. And the overhead budget is probably supported by departmental schedules that give you fixed and variable costs. And here's an example of a factory overhead cost budget. They put these numbers together, so they've got indirect wages, supervisor salaries, power and light depreciation, indirect materials, yada yada. So our total overhead cost is about just over $2 million. Okay, this is their estimate for the year. And that's it. Okay. Finally, cost of goods sold. Cost of goods sold, we need direct materials, direct labor, and overhead. Okay, and the estimated and desired inventories, all of that is integrated into the cost of goods sold budget. So here's an example. This is what the leather wallet people have. I've got direct materials. There's my beginning inventory. And I've got direct materials, work in process, and finished goods, just to really complicate things. My desired inventory at 12/31 is over here, 104.4. Okay. Oh boy, they sure made this tricky. So we've got finished goods. This is a whole, almost, it's like cost of goods manufactured within cost of goods sold. Now, if you hear cost of goods sold, then we're looking at finished goods inventory, and that's right out here in this column. Beginning finished goods plus cost of goods manufactured gives us goods available, less ending inventory is cost of goods sold. Okay, so your income statement is right here in the third column. If we go in from that a little bit, this is work in process. Okay, beginning work in process plus total manufacturing costs gives us the total work in process during the period. What's this? Less ending work in process is cost of goods manufactured. Okay, all right, and in the inside then is all the details of work in process. So it's beginning inventory plus purchases is available, minus ending is materials in production. Add direct labor, add overhead, and I've got total manufacturing costs. So if you started 3 columns in, maybe put an outline down and then work from here. Okay, start with your materials, then add labor and overhead. That flows into work in process. Beginning work in process plus total manufacturing cost. That's what this is. This is what we did this period. Gives us like sort of, I don't know, what's sort of what's available for the period, less ending. That's my cost of goods manufactured. So all of these totals are like cascading across here. Okay. Oh, it's sure not easy, is it? So we're not going to do this. It'll take forever. We'll work some problems together, okay? Now for selling administrative expense, it's really straightforward. The departments give you the selling and admin expenses and you're all set. Okay, you've got the numbers and you just use these numbers directly in the budget. And they're all straightforward. Okay, they're not manufacturing costs, they're just selling expenses and administrative expenses. And then we prepare a budgeted income statement and we add together all these budgets. We've got a sales budget, we've got cost of goods sold, and then selling and administrative expenses. And that's pretty straightforward. If we've got other income and expense and tax, you can also put that in there. Okay? And what this does is it summarizes the budgeted operating activities of the company. So this allows management to see what next year might look like. Okay, what if those are our budgeted sales, what's the bottom line going to look at? What are my costs and my expenses? What had the biggest impact on profit? And here's an example. Well, it's just an income statement, but this is why we had to do that financial piece first, so you understood this. But there's our revenue, that's cost of goods. So there's the sales budget. This is from cost of goods sold. Here we've got selling and administrative expense from selling and administrative expense budget. Gives us income from operations. And then we've got a couple other things that were added down here. I'm assuming that's probably enough for you right now.